5 real strategies that investors are using right now. No hard money drama, negotiating rates and terms, no seller financing, no subject to deals. Just get in, get pumping, and here we go. So, what's the big idea? What if you could flip a property with zero out of pocket? The problem everyone faces is most aspiring investors assume they need a large cash reserve for down payments, closing costs, and rehab budgets. And that assumption is just costing them deals every single day and bottlenecking them from scaling. So the real opportunity here is there are 5 proven, legal, and repeatable strategies that let you go into fix and flip deals without a pile of cash in the bank. No exotic seller negotiations, no praying a loan doesn't get called due, just smart financial positioning and execution. So we're breaking down all 5 with real numbers and actionable steps you can start using today. So strategy 1 and 2, we've put this together in one because it's fixed term loans that can both be used as debt consolidation to raise your DTI, but also get you into the deal for down payments, closing costs. So the whole idea here is your credit card debt isn't just hurting your wallet, it's destroying your debt to income ratio. And your DTI is exactly what lenders scrutinize before approving you for any deal. So what's the move here? So consolidate all scattered credit card balances into one fixed term loan, typically 3 to 5 years. So it's a smaller monthly payment, freeing up cash flow. It's usually a lower rate, no prepayment penalty. Now that's key. So when your flip closes, you wipe it out immediately, no fees, and keep pumping. Here's a real example. So you got 18 grand across 4 cards at $680 a month. This is what we see all the time. So you consolidate into a 3-year loan at $540 a month, and that $140 a month difference opens up borrowing room and improves your DTI profile instantly. So it's not just freeing up cash flow for the deal, but it's actually improving your profile for better rates, better terms in less than a month. As soon as that updates to your credit profile, it's one of the biggest levers you can pull. So we got lower monthly obligations, free up cash flow, improve your DTI, and make you far more attractive to lenders without just crossing your fingers and hoping your score jumps on its own. Now, I must mention here, to enter this flow, you want a bare minimum of a 640 credit score. So if you're below that, just go fix it up. You can use tools like Dispute Beast these days, do it with AI instead of paying hundreds of bucks a month. So second strategy, you probably heard of credit card stacking. So these are 0% intro APR credit cards, business and personal. We'll go into both, but one of the most underutilized tools in a real estate investor's arsenal. Open a card with a 0% intro period, typically 12 to 21 months, and you're borrowing money for free. So it's easier to qualify on the personal side with a solid personal credit, lower credit limits typically, but the stinger is it reports to your personal credit. So it impacts utilization DTI, but it's still powerful if balances are managed carefully. And you plan to do 1 or 2 flips while you've got that limit, because as soon as you pay it down, again, that DTI, lowering that will just boost your score back up to where it should be. On the other side, we've got the business cards. So this is the real play we want to do. Many do not report to your personal bureaus like Amex, Chase, Capital One. They've got higher credit limits available and build your business credit profile simultaneous to get you ready for business lines of credit, which we'll go into soon. So all it requires is an EIN and some business history. Just making sure you've got those things like just making sure you've got a proper address, phone number, you've checked your NAICS score, that it's not a risky lending category. And then here's the Plastiq play. You might have heard of Plastiq or Melio. We use a service like Plastiq to convert your credit limit into actual cash. So you can go and take these limits, say you get 100K worth of business and personal credit cards, you can liquidate that into your bank account, pay contractors, cover closing costs, fund rehab draws. Typically, it's a 2.9% fee on, say, 20K is $580. So if your flip net's 40K, that's just noise if you compare it to other interest rates you could be doing. So once the deal closes, you pay down the card, those lines are reset for your next deal. So rinse and repeat, expanding your limits and starting to scale faster. Now let's get into BLOCs or business lines of credit and net 30 trade lines to start building your business credit. So this is a long game most investors completely sleep on. It is a bit of a long game that investors completely ignore, and it's one of the most powerful credit building engines available to you. So, what is a business line of credit? Works like a credit card, but with higher limits and lower rates. Draws what you need, pay it back, line refreshes. It's ideal for fix and flips where the cash needs aren't necessarily up front, except covering that first draw. And lenders want to see typically 6 to 2 years of business history and bank activity. Now, the way we get there to start building these lines and start building our business credit is net 30 trade lines. So when working with contractors, what you can do is negotiate that you can negotiate to buy the materials directly using a vendor or a net 30 account, pay on time, and that invoice reports to the Dun & Bradstreet Experian business and the Equifax business. So you stay in control, you build credit, everyone wins. Just tell the contractor, mate, I'll pay your rate. I just want to pay for the materials through your account and on my card to build business credit. So work with 4 to 6 vendors consistently so that within 6 months, your business credit score can actually qualify to 25 to 100K in business credit lines. And your credit file gets stronger with every single deal you do. Strategy 4. So if you already own a home with equity, you may be sitting on the best funding source without even realizing it. Specifically for fix and flips, you need an exit strategy because a home equity line of credit lets you borrow against up to 85% of your home's value minus what you owe. Quick example here. So if your home's worth 300K, you owe 180K, and that's 120K in equity. At 80% LTV, you could access 60K revolving line, lower those rates, and then hard money, renewable, and then flexible. It's got lower rates than hard money. Typically, it's renewable and it's flexible. So you're not paying interest on the whole HELOC. You're just pulling it out what you need and paying interest on what you're utilizing. Very much like a credit card. So pros and cons at a glance, it's lower rates than hard money lenders. It's revolving, so you draw, repay, reuse. Interest may be tax deductible. Talk to your CPA about that. And your home is the collateral. So this is the real risk. If you don't have an exit strategy, variable rates, it could, down the road, if you're doing this on a long-term hold, rates could just eat you alive. And this takes 30 to 45 days to set up. So you got to plan ahead with this one. Here's the footnote. So only use a HELOC on a deal you've fully underwritten. This tool's powerful, but it works best for disciplined investors with a clear exit strategy. So here's your roadmap, the 5 strategies, one clear path to your first flip. It is a bit of a ladder. They go in order as you build your credit. So fix your DTI, lower your card utilization, get out of credit card debt, and boost your credit score very quickly. You need about a 650 credit score so that once you're at a 700 plus, we can go and leverage the 0% interest credit cards. Now, you do have to apply for these in a specific order to get the max limits possible. So talk to us if you want to know how to do that. Build business credit. So establish those net 30 trade lines, start putting some expenses through them. Then open a business line of credit, access revolving credit for the deals, and you can also deploy a HELOC. So here, this is for established businesses doing revenue, and this is for people with a home with equity in it. So these strategies, they're designed to stack. So start with cleaning up your DTI, layer in the 0% credit tools, build your business credit profile through trade lines, unlock a business line of credit, and tap into some home equity as a low-cost revolving fund, if possible. If it's your first deal, no worries, just start here. Each step makes the next step easier. So if you're ready to bridge the gap on your next deal, ready to get into a deal with 0 down, these strategies take time to build, but sometimes you got a deal right now. You're short on the down payment, closing costs, rehab budget, or working capital, and that's exactly what gapfunded.com is built for. So those down payment gaps, we help bridge what you're short without exotic seller negotiations, rehab funding, cover your renovation draws so your project doesn't stall mid, which is one of the biggest killers of a deal, as I'm sure you're aware. And then also working capital, so keep operations moving from acquisition through to closing day. No seller finance, no sub twos, no hoping the other side agrees to your terms. Just hit that link and let's look at a specific situation. So the term loans can typically land within 48 to 72 hours. If you've got a deal on the line, let's have a chat. I'll see you there.